Happy weekend, everyone. Sam, the Money Geek, coming to you from Canton, Michigan on a Sunday, May 17th, 2026. It's been a while since I've done one of these. And so I thought I'd give you about 5 minutes of my thoughts on the market and what's going on with the economy. So we've had a great run since the market bottomed on March 30th. And as you'll see, the market is up about 18% from the lows. And that's an incredible run. That's more returns that you normally see in 1 year, let alone a month and a half, and we had a little cooling off on Friday, but so far earnings are coming in really solid, and the market is reflecting very solid earnings and no signs of a recession to come. But it's not all sunshine and rainbows. We're seeing a little bit of a tick up in inflation as well as interest rates. So, with a new incoming Fed chair, Kevin Warsh, who took the helm on Friday, the market thought appropriate to deliver a little message about don't even think about raising interest rates. So let's take a look at some of the parameters and things that are important for the markets. And we'll start out with a view of what the market's been doing. So you can see where it says today, that's Friday's action. So the smaller the stock, the worse it fell. But overall, for the week, not too bad. We hung in there. And you can see these returns for the last month and year to date are really off the charts. So you can't complain about returns like this, especially when things through the end of March weren't looking too great. So on a 1 year basis, S&P 500 up 26.62%. That's on average 2.5 years of gains in basically 1 year. NASDAQ up 39%, and microcaps, the smallest of the capitalizations, up 57%. So, and mostly you can see if you look at on a sector basis, technology is leading the way, with energy a close second after the results and what's happening with the war in the Middle East and the price of energy, which you've no doubt noticed at the pump. All styles of investing are doing well. You can see 1 month, year to date, everything is positive in the green. You go out to the world markets and they are doing as well. Not as good as they did last year. Last year, the outside the U.S. did a lot better than the U.S., but still none of them are any slouches. And you can see some countries doing a little bit better than the others, with Brazil on a 1 year basis up 29%, Japan and the US, of course, up about 25%. And finally, what you saw on Friday and the continuation of weakness in the bond market. So we've seen bonds of all kinds, long-term bonds, just corporate aggregate bonds. The only thing that's really up on a 1 year basis are the Treasury inflation protected securities, which is the inflation protected bonds, and the aggregate bonds and short-term corporate bonds. So not much in the way of relief on the bond front in terms of rallies. And you have to remember that when interest rates go up, bonds tend to go down. So that dynamic has not changed one bit. Commodities, a lot of positive, unless you are natural gas, even though it's scarce around the world, except in the US, still down 32%, but silver, look at that, 133, over 133% in 1 year. Gold, platinum up 97%, oil up 82%. So that's kind of it as far as the markets. But we look at the economics and we can see that it's kind of a mixed bag when you think about it. Existing home sales did tick up in April, but we also have seen that new home sales are also stalling. So it's a little bit of a concern point that existing home sales and new home sales are ticking up slightly, but interest rates and affordability are really affecting the housing market. And the housing market is really important to the U.S. economy. And we need to see that building permits, which are looking lower in the coming months, we need to see that tick up, because lower building permits applications tend to portend lower new home sales. NFIB, Small Business Index, essentially unchanged. So small business owner are relatively pessimistic, but not really. But you can say that it is a pretty positive environment, but some with inflation and them trying to hold prices steady for the consumer and fighting their own inflation battles, they're not as optimistic as they usually are. But what came out of the gate last week with the consumer price index shooting up from 3.3 to 3.8 and core CPI going from 2.6 to 2.8, pointing to inflation coming, which is going to put the Federal Reserve on hold for any further interest rates cuts. When we were coming into the beginning of this year, we were expecting 1 to 2 interest rate cuts. I don't believe we'll see any interest rate cuts, nor do I believe that any are warranted. Producer price index, which is wholesale inflation, also rose rapidly, 4.3% year over year in March to 6% in April. So essentially, inflation is sticky, and it's not just energy inflation. We all see the prices at the pump, but and those affect a lot of different components, but still, wage inflation, while stable, is still up there, and so is the price of all goods and services. And we all know that without even having to hear or listen to the stats. But when you look at things and you see a market that is essentially gone parabolic, here's the low all the way up to through Thursday's high. That was an increase of about 18.5%. And that's just on the S&P 500. And you look at the NASDAQ, and that's the tech heavy index. And that's even, look at that run, parabolic. So we are 28% on that run from March 30th through May 14th. And this little dip on Friday was kind of just that, just a little blip so far. And it would really do the market a lot of good for it to do a little back and filling for a while, given this torrent run and basically packing 2 years of gains into a month and a half. That's not sustainable, and it's not desirable to keep this market going. It would be nice to see some sideways action for the future. But for the most part, the markets are in great shape, and the economy is in great shape. Earnings coming in at record levels, with about 90% of the S&P 500 coming in and having reported. We have record earnings and no signs that they are marking down the upcoming earnings. So we should see some backing and filling in the markets coming up over the next couple of weeks. Hopefully that's what will happen. And if not, then we will see a little bit more weakness. There we go. We pop right back up. So technology is wonderful. In any case, we could use some backing and filling, and we may see some pullback of 4 to 5%. That would not be unhealthy at all. But I remain optimistic. When you have gains like this at the beginning of the year, they tend to persist. And when I was thinking high single digits of returns into the year end, and we're already at double digits, that portends good things for the rest of the year. So that's all I have for you today. Hopefully you found this helpful. You can follow me on Twitter at The Money Geek, or you can reach me at sam@ydfs.com if you have any questions. For now, have a great week ahead, and I appreciate you tuning in. Talk to you next time. Bye-bye.